So, okay, let me just try to delete these things. So crash 300 is still within our selling range, because our selling range is always a resistance, is always a selling range. For example, this whole zone, this entire zone here, according to the daily time frame, it's a selling range. So here at this zone, if you check here, previously price failed to close higher than that zone. So basically, if you had marked this entire zone here, price, so long as below this entire zone, it will be presenting selling opportunities. You actually need to look for selling opportunities when we are close below that zone like that. So if you check now, this range now, this range here, what happened was price faked out here, faked out of the range, faked out, then went back inside. So here now, this candle here, it's sort of like a break of this bottom line of the range, this one, because this bottom line of the range is this zone here, which is also a significant zone. The top line of the range is those two wicks there. So both of the lines, they are significant for our entries, very, very significant for our entries. So here now, this bottom line of the range was broken here, never retested. This one was broken, retested here, the top one. Then the bottom one, broken. Then most probably, this can also happen, whereby price goes back to test here, then it continues to go to the downside, because that area hasn't been tested. So that is one way we can look at crash 300 from where it is. And also you can also consider market structure on the daily time from there. We had higher highs, higher lows, higher highs, higher lows, higher highs there. Then here it came and broke these lows, went back all the way to make a higher high. So after making that higher high. So now it went back now and made the higher low here, higher low there. Then now from that higher low, it went and made a what? A lower high. So this high is lower than this one. So this shift whereby we have a lower high and also this lower low was broken. So the break of the lower low here is where most probably the retest can happen. The break of this lower low here, because we're saying higher high, higher low, lower high. So this low was broken. So after breaking a low like that, it's like breaking a level of support, basically. So you can actually mark out that area. You can actually mark out that area because it's actually a significant area where this pullback can come all the way to. So we are saying this higher low, which is this area basically here. We can also, price can also retest to that area if it doesn't come all the way to that key level here. So that area and the key level that we have on the daily, they are very, very key significant areas when we are looking at the overall picture for our C300. So that area, it's actually my significant zone, and also this one, that key level. So this low here, this lower low, this higher low here, broken here. So this retest can even come to test this broken higher low, broken higher low. So this retest will simply be, so it will simply be a continuation of a bearish market structure, because we are saying we have a lower high here, then the break of this higher low to make a lower low here, to go back and make a higher, to go back and make a lower high there, to come back and break this lower low, to go and make a So it will still be a continuation of this bearish market structure that we are currently seeing. So that area is a very, very significant area, very, very significant zone there, very, very significant zone for our C300. So the buys that have been happening, if ever someone is not aware of what is happening on the higher time frame, someone might actually think Crash 300 is actually uptrending. Yet there might not even be such an uptrend, but basically it would be simply a retest to a major area like that. So like for people, if you check people, there are people who never visit the daily time frame to actually see, sometimes due to lack of knowledge and exposure to the markets, they don't visit the daily time frame to actually see what is causing the moves that are happening on the lower time frames, what is really causing it. Because if you're only going to be looking at the smaller time frames, you can actually see a sort of like mini uptrend. And if ever you're not aware of what is happening on the higher time frame, you can actually be led amiss when the time to now go down is now arrived, like there or here. So that's why it's very key to always start from the highest. I always wish this trading view could offer the weekly and the monthly, but I don't know why it doesn't, because those ones are also key now. Those ones you can actually go to your MT5, you can actually see them, the weekly and the monthly. They can also give you some bit of rough bias on what can possibly happen, but the daily is the perfect one as well. It's the very perfect one to start your top-down analysis. So once I've identified my key area where I'm expecting the pullback to come to, you can also include your Fibonacci, whereby you have that point A there and point B here, right? This is my Fibonacci. So this area, you can also see that it's close to the 61.8, which is our golden Fibonacci area, which is also a very, very good sign, because once we get those rejections there, we'll enter based on this confluence. The first confluence being a broken lower low or a broken support, which has now turned into a resistance, number one. Number two, that would be a formation of what do you call this, a lower high on the market. Another factor, it would also be on the Fibonacci, 61.8 Fibonacci. So those three significant confluences plus you can also include your 50 exponential moving average. You can also include it as as an additional confluence. So when it comes to the moving averages now, I think I now need to tell you something else now concerning the moving averages. Concerning the moving averages, they also, as I said, that they are dynamic support and resistance. They move with the market. They're different from this zone. This zone is a resistance, but it's not dynamic. It's not dynamic, meaning it doesn't move with the market. It's stagnant there. Moving average, what they do, they move with price. When price is moving, they also move. So that's why you also just need to add them as an additional confluence, but you don't need to base your trading decisions using a moving average only. You actually need to combine it with all these further important factors like your Fibonacci, your market structure, your trend lines, and all these other factors. So when it comes to Fibonacci's, when it comes to moving averages, we also have major moving averages and minor moving averages. Major moving averages, they can show you the overall direction where that particular instrument has been going. It can show you that. Then we have other moving averages that can show you the particular trend of that particular instrument right now. Then they also have another moving average that can give you entries. So basically there are three significant moving averages that one can have or apply just as an additional confluence to whatever that you'll be doing. So these ones, you're not basing your entries, you're not fully basing your entries just using them only, but you're adding them on top of the analysis that you'll be having. You simply add them. Then when they're adding to your confluence, that a particular trade will be having so many confluences. So for example, the long-term moving average that we have is the 200 exponential moving average. 200 exponential moving average. Just go to your moving averages, then here on the length, you go to the exponential moving average, then to the length you add 200. So that one now is for the long-term direction, long-term direction of the particular instrument. So that one now, that is a moving average that you see, if ever the market breaks that one, definitely it would have broken a major trend, and most probably it would be going very hard to the opposite direction. So if you check now, my 200 exponential moving average right now is below the market, because what it is simply saying when it's like this, it's simply saying this market has been uptrending. So if you check here, price has been uptrending here. After it was down here, after it broke inside, it got a retest because it's also a resistance. So broken here, it was a resistance, broken, now it's a support, came back to be retested. So this retest was simply back to that moving average. So now price was now being monitored by that moving average. All these buys that were happening were having this foundation of this exponential moving average supporting them. So this break and retest of this exponential moving average, you can also look at it in this way. Since we said there are also levels of support and resistance, you can also add a level of resistance there. You also realize that this break was also a break of this resistance. So that's why I said it's a dynamic support and resistance, because it moves with the price. So here you actually had two confluences, this resistance and also the resistance of the moving average to enter these buys, obviously. So that was what was happening. So basically now, that is weight is still below, but most probably for the market to come now close to it, that will actually be a very huge move. For price to crash, to come close towards it, it will actually be an opportunity that if someone is simply using this moving average for interest, they are not going to get all those opportunities. That's why I say it lags behind moving average, and all indicators, they lag behind the market. They always follow behind. So you realize that all the sales that are going to happen from there to up until when it comes to touch this moving average and most probably break it and retest it and go, most probably these ones, these initial ones, many people use indicators only, they're going to miss all these ones. So in other words, they're going to enter late on the market. So that one is simply for the overall. So you see, as it will be crashing, it will be crashing. Once it crashes and comes close to it, I want you to see what will happen once price comes and breaks these moving averages. Once it breaks this moving average and retests it, most probably it's going on a long-term sell. So as you'll be doing our analysis every day, we'll just be looking at it as price will be crashing. You'll just be looking at your moving average. Once price comes close to it and breaks it and retests it, it's also another opportunity, because I think most probably this market can touch this moving average, maybe somewhere here, if not here, somewhere here, somewhere on these areas. That's where most probably this price can come to touch this moving average, break it, retest, then boom, continue going down. So that would just be a long-term thing. So I personally don't need it right now on my chart. I can simply look at it later on when price comes close to it. Then the next one is the 50 exponential moving average that we spoke about. That one can also help you. It also helps you with the current trend. Also helps you with the current trend of the market. For example, right now, for example, when you see, for example, here, this was a break break, retest, came back to test. So when you see price coming back to test, for someone who understands moving average, you realize that whenever price comes back close to your moving average like this, it actually closes above your moving average. For someone who understands them, they actually know that those were actually opportunities without even placing trend lines or anything. Just looking at this moving average, all these areas where price came close to the moving average and closed above it were simply opportunities to buy, and buy. So right now, this moving average right now, it's still below the price. It's still below the price. So what we want now is for the market to crash and go below the moving average. Once it goes below this moving average, it's simply a sign that most probably our trend now is fully changed. In as much as we are seeing signs of a trend change already, whereby we have a shift in market structure already, that's where now someone who knows price action is always ahead of someone who knows indicators only. For someone who knows indicators only, like the moving average, basically what they are waiting for, they are simply waiting for price to come and break below this moving average for them to know that the trend is already shifted. But for us to understand price action, already we can see that the trend is already shifted based on this shift in market structure, where we have a lower high here, which is lower than that one. We have a break of this lower low, most probably a retest of that lower low here. So basically, to us, already the trend is already shifted. Already the direction is already shifted, but to someone who is always looking out for the moving average only, they are still waiting. So meaning they are going to follow us. They're going to follow behind us. They're going to always be behind us. So that one as well, its break as well is also significant. It can also happen maybe somewhere here. It can also happen maybe somewhere here. So whereby price will come, break it, retest it, then continue going. It will just be an additional confluence that you can look at to say, okay, now we are downtrending. So that uptrend that has been happening, if ever you also added a moving average as an additional confluence, you could have easily seen it clearly. If ever you are not yet perfect in your price action analysis, you could have simply added your moving average. You could have actually seen it clearly that my moving average is below the market. My market is above the moving average. So basically we are in an uptrend. You could have seen that easily with the moving average if ever your price action analysis is not yet on point. But for someone with a price action skill that is on point, you don't need to even have it to know that the market structure has shifted. So market structure already shifts before it even comes and breaks this moving average. So it's also significant. You can also add it as an additional confluence to your analysis, just to see what is most probably happening. So here it's still below, still pushing price higher. So now, once we get a retest there, ask as price action analysis and get a rejection there. To us, we already have a shift in market structure. We can even start selling there. And then you see that many people who use moving averages, they can even wait for this break to happen for them to enter, which to us would be in already earlier than them. So that is also another moving average. Then the last one that one can consider, which is what we call the entry moving average. The entry moving average. The 50 EMA can also be used as an entry moving average, because that one is the best now, the best one. Then we also have another one, but that one is not as accurate as the 50 EMA, because sometimes it's manipulated. The market makers, they actually play around with it. So this one now, it doesn't show you the overall direction. This one, the 20 exponential moving average, is not for direction. It's not for direction, this one. It's simply for entries. It's not for direction. You don't use this one for direction. It's simply a confluence that you can use simply for entries, entry points, stop losses, entry points, stop losses. So for exit points, whereby let's say you want to swing trade, when you are swing trading, you can use the 50 and the 200 as well, working together like that. When you want to swing trade, you actually know that if I buy here, if I buy, let's say if I bought there, for the swing trade, if I want to look for an exit point, let's say just using the moving average, of which as we use exit points using other confluences, not only this one. So for exit point, someone will look for an area where price will come below. So if you check here, price was still being maintained above. So meaning they are still holding their buy, still holding their buy, still holding their buy. Here tried to break but never retested, still holding your buy. So someone who is still holding this buy, they're simply waiting for a moment where price will come and break their moving average and go below it, retest it. Then once that happens, they will come out of their buy. That is someone who will be swing trading using just following the moving average. So it can also help you when it comes to swing trading. The 50 EMA can also help you when it comes to swing trading. You realize that once it's broken, for us as price action people also know that here the break of the moving average, you can also have a trend line there. Most probably you realize that there actually is a trend line there. So those three moving averages, you don't need to always have them on your chart. Hear me? You can actually confuse yourself by simply having them all the time on your chart, because I said they are additional confluences that we use after we have done our price action and our analysis, after we've seen our levels of support and resistance, our Fibonacci's, our trend lines. After we've seen all those factors, we simply add the moving average, the particular moving average that you want, as an additional confluence, not as a decision maker to say, this is what I'm going to use to make a decision. No, you simply add them as an additional confluence. So you realize that this trend line weight is most probably close to where the 50 exponential moving average is. You realize that the break of this area here, it will also be the break of the trend line, and also most probably the break of this moving average. So that's simply a strong confluence, whereby once you get that break like that, and you get that retest, it will simply be strong confluence, because the moving average will now be above, the trend line would have broken and retested, this support will now be turned into a resistance. So all those factors, they are simply saying the same thing, but it's actually additional confluence that one can look at whenever they're analyzing. So this trend line is a major trend line, but this trend line, if you actually have to wait for this trend line to enter sales, you will enter late, because the sales that are going to happen from here or wherever they're going to happen, you're going to miss them. So you're simply like someone who is waiting for the break of that moving average to happen. So even on trend lines, you realize that there are major trend lines and minor trend lines. There are trend lines that can give you late entries. There are trend lines that can even give you earlier entries. So this trend line basically to give us a late entry, which would be obviously a major sell that will be happening, just like what happened on the VIX, whereby we have a major break of a trend. This is a major trend. Once it's broken, it actually shows you that most probably we are now in a major downtrend. So for now, these are the things that I want. These are the things that I can look at, because I'm looking at entry points either on the key level or on the yellow zone. Then this is a daily time frame, remember. Then the holding, we can hold to here, and this trend line as well. So if you remember, we actually spoke of this drop here that came to the trend line. We actually spoke about it, whereby price had broken below this zone, then was now going up to test again that zone. So there we said, here price, once we get a rejection, it's going to sell all the way to the trend line, of which it did 1, 2, 3, 4, 1, 2, 3, 4, almost close to 4.5 days there, holding that trade. So same as here, we are simply expecting a rejection somewhere here. Then from there, our first target is this area and this trend line for those cells. So basically, these are the only things that I need right now. I don't even need to draw any key levels and waste my time drawing any key levels at the bottom here, because the market will come there after a very long time. So right now I'm focused on where price is and where the market is, because that's where we want to be trading, not next week or next month. So these are the only things that I need on my daily time frame. So you're going back to a lower time frame, you're simply looking out for factors that are in agreement with the daily time frame as well. So this is my 4-hour time frame. On my 4-hour time frame, if you actually check on my 4-hour time frame, another confluence that you can also have is this trend line here, which was broken here, this broken trend line. So this broken trend line, you realize that where price is most probably going, it's actually also close to our area where we marked, this area that we marked on the daily. Price can come, and so price coming and respecting here, there is also respecting also this trend line as well that we're having on the 4-hour, which is good for us, as well. So another thing here now, this area here, it's also close to the neckline of this double top that happened. If you check the double top that happened here, top, double top, neckline, the wick of the neckline is most probably close to this zone, which is actually good for us because we know this retest, it might also be a retest to this neckline of this double top, which is good for us as well. So all those factors are simply adding to our confidence that we are seeing, to the analysis that we are seeing on the daily, whereby whatever we are seeing is now in agreement to what we are seeing. So these smaller time frames, they are always going to move to agree with what the higher time frame will be saying. So they actually move according to what the higher time frame will be saying. So they, even if you use a Fibonacci as your target, and decide to forget about the resistance and the trend lines that we spoke about on the daily, even the Fibonacci, you realize that these things, they actually confluence with one another. They actually will be agreeing with one another. You realize that here on the 0% is most probably close to where that major daily trend line is. Most probably close to where that trend line is. So here, somewhere here on that zone, we are expecting our entries. Somewhere here on that zone, we're expecting our entries for the day. I think that is going to happen maybe later on today. That is where price will be close to there, because where it is right now, it's not really a major area. If you remember what I said, where price is right now, it can give some little rejections, but it's not really a major area to say it's a major key level. It's not a major key level, but it's also a significant level. So if you check now, once this 4-hour candle, as it is closing in about 42 minutes, once it closes above this area, it will simply be showing you that price most probably is going to push all the way there. So someone might say, why not buy? You can even decide to buy. One can even decide to buy maybe to that area. You can decide to take a buy based on a lower time frame entry. If you enter on the 4-hour, this stop loss will be too much for you. So you can even look for a buy upon the break here. Once price closes above, you can look for a buy to the area where we're expecting sales. So that is also allowed. It's also allowed to even buy as you are waiting for the sell. It's allowed, very much allowed to buy as you are waiting for the what? For the sale. You realize that a long-term swing trader, what they can do sometimes, they can even come here. They can even come here. Let's say you caught a sell there and maybe caught sells here. And you know that most probably I'm expecting a huge long-term move on this crash 300. Basically, one can decide to hold this sell and these ones as well, even though the price is buying like this. Then once they get an opportunity, maybe to buy, let's say here, they can even buy while it's holding sells. It's allowed. You can even buy while it's holding these major sales, because these ones you want to hold for longer. But these sales, you know that most probably I'm going to come out early. So one can even buy while it's holding the sales. That's also another way of swing trading. But that one is good if your equity is also stable, because if your equity is not stable, all you want is to build the equity. That one is good when your equity is stable. You can even buy while it's holding the sales. So one can even, one might have even bought there. Right now they are holding buys. As they are holding sales, they have buys. So these buys, they're going to give them profit, maybe up to there. Then they close the buys. Then they enter more sales here. So meaning they now have sales there, sales here, and sales there. But they actually made and used this opportunity as they were waiting for the price to come where they wanted. They are not simply folding their hands whilst they are seeing an opportunity. They are simply taking advantage of every single opportunity that would be there. So that is the major area that I'm expecting price to come to, major zone that I'm expecting price to come to. Once it comes there, it's simply opportunity for entry, opportunity for entry. So you going back to a lower time frame, the 1 hour, the 30 minute, you're simply going to look for confluences that are confluencing with what you saw on the highest time frames. So here you can already see that prices are almost closing above that zone. So it's simply a mini buying opportunity for someone that they can even decide to take. So yeah, so the zone that I'm expecting is somewhere here on that yellow line or straight on the trend line, somewhere here between these areas there. That's where I'm expecting this move, this crash 300 to come to before we take sales. So I hope it's clear. I hope it's clear for the crash. I hope it's clear for the crash. This trend line, you can also use it as your guide to guide you. If ever price comes all the way to the trend line, that will actually be good, because you can actually get an earlier entry. If it comes all the way here, you can even get an earlier entry there. Then someone can wait for the 61.8. If price comes below there, then also add sales. Then you also look at these areas as well, these significant areas. You can also look at them. Once they are broken and price comes below them, you can also consider adding sales. So crash 300, that is what we are most probably seeing right now. That is most probably what we are seeing on our crash 300.